Look, I need to tell you something that's happening right now in the silver market that most people have no idea about. And if you're holding unallocated silver, you need to understand what that actually means before it's too late. Let me start with a story. Back in March 2020, when the world shut down, something extraordinary happened in the silver market. The price of physical silver bars and coins shot up to $30, $35, even $40 an ounce in some places. But here's the weird part. The paper price, the spot price you see on your screen, was sitting at $12. How is that possible? How can the same metal trade at three different prices at the same time? The answer reveals everything you need to know about unallocated silver. See, when you buy unallocated silver, you're not buying silver. You're buying a promise. You're buying an IOU from a bank or a dealer that says, "We owe you this much silver." And that promise is only as good as their ability to deliver when you ask for it. In March 2020, people started asking. And the system nearly broke. I watched dealers shut down their websites. I watched premiums explode. I watched delivery times go from 2 weeks to 4 months. Why? Because the silver wasn't there. The unallocated silver that millions of people thought they owned didn't exist in physical form. It was just numbers in a computer system, backed by a fractional amount of real metal. Now here's why this matters right now, today, in December 2025. The same conditions that caused that breakdown are forming again, but this time they're worse. Much worse. Let's talk about what unallocated really means. When you have unallocated silver, you're an unsecured creditor. You don't own silver. You own a claim on silver that the institution might honor if they can. If they go bankrupt, you're standing in line with everyone else hoping to get pennies on the dollar. If there's a run on physical metal, you're hoping they can source it at reasonable prices. If there's a force majeure event, they can settle your claim in cash at whatever price they decide is fair. Think about that. You bought silver to protect yourself from currency debasement, from inflation, from financial system risk. But if you hold it unallocated, you're exposed to all of those risks anyway. You're trusting the very system you were trying to protect yourself from. I talked to a dealer last week who told me something chilling. He said the ratio of paper silver to physical silver in the system right now is estimated at somewhere between 100 to 1 and 250 to 1. That means for every ounce of real physical silver that exists, there are 100 to 250 claims on that same ounce. Now, this works fine as long as everyone doesn't ask for delivery at the same time. But what happens when they do? We're seeing the early warning signs right now. The U.S. Mint sold out of Silver Eagles in November. They've had to ration production. The Royal Canadian Mint is running 6 to 8 weeks behind on orders. Dealers are paying premiums above spot just to acquire inventory. And this is happening while the paper price is still relatively subdued. Why is this happening? Let's follow the money. Industrial demand for silver is at all-time highs. Solar panels alone are consuming over 200 million ounces a year, and that number is growing by 15% annually. Electric vehicles use twice as much silver as traditional cars. 5G infrastructure is silver-intensive. AI data centers require massive amounts of silver for their electrical systems. At the same time, mine production is flat to declining. We're not discovering new silver deposits at the rate we're consuming existing ones. And here's the kicker. 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. When those mines become unprofitable or face operational issues, silver supply drops as a side effect. So you have surging industrial demand, declining supply, and a massive overhang of paper claims on physical metal. What do you think happens next? Let me tell you about the COMEX, because this is where it gets really interesting. The COMEX is where silver futures trade, where the paper price is set. In a normal month, maybe 2% to 3% of contracts stand for delivery. The rest are rolled forward or settled in cash. It's a paper trading game. But watch what's been happening. In the last 6 months, delivery requests have been running at 8% to 12%. That might not sound like much, but it's a massive increase. And the COMEX warehouse stocks have been drawing down. They're not empty yet, but the trend is clear. More people are saying, "I want the actual metal," instead of just trading the paper. Now, the COMEX has rules for this. If they can't deliver, they can declare force majeure and settle in cash. But here's the problem. If the COMEX declares force majeure on silver, what does that do to confidence in the entire precious metals market? What does it do to the price of physical silver when people realize the paper market can't deliver? I'll tell you what it does. It creates a two-tier market. Paper silver trades at one price. Physical silver trades at another, much higher price. And if you're holding unallocated silver, you're stuck in the paper market. You're getting the paper price, not the physical price. This already happened with gold in 1933. The government set the official price at $35 an ounce. But physical gold was trading in Europe at $50, $60, even $70 an ounce. If you had gold in a U.S. bank, you got $35. If you had physical gold in your possession, you could sell it for the real market price. History doesn't repeat, but it rhymes. And right now, it's rhyming pretty loudly. Let me give you another example. In 2008, during the financial crisis, there was a brief moment when you couldn't buy physical silver at any price. Dealers were sold out. The mints were sold out. But the paper price was crashing because of forced liquidation in the futures market. People who owned unallocated silver watched the value of their holdings drop, while people trying to buy physical silver couldn't find any. That disconnect lasted about 6 weeks before supply chains normalized. But what if it lasts 6 months next time? What if it becomes permanent? Here's what I'm seeing right now that concerns me. Central banks are buying gold at record pace, but they're not buying silver. Why? Because they can't. There's not enough silver in large enough quantities for central bank-sized purchases. The silver market is too small. But that also means when the squeeze comes, it's going to be more severe in silver than in gold. Retail investors are starting to figure this out. Sales of physical silver coins and bars are running 30% to 40% above last year's levels. But most people still hold silver through ETFs, through unallocated accounts, through paper proxies. They think they own silver, but they own promises. And here's the thing about promises. They're easy to make and hard to keep when everyone wants to collect at the same time. Let me talk about the banks for a minute. The big banks that offer unallocated silver accounts, they're not stupid. They know the math. They know they're running a fractional reserve system, but they also know that historically, only a small percentage of customers ever ask for physical delivery, so they can operate with a fraction of the metal they've sold claims on. But what happens when that percentage changes? What happens when, instead of 2% of customers asking for delivery, it's 10% or 20%? The system breaks. And when it breaks, they have options. They can buy metal on the open market to fulfill deliveries, which drives the price up and makes the problem worse. They can delay deliveries, citing supply chain issues or force majeure. Or they can offer cash settlement at the paper price and hope you take it. None of those options are good for you if you're holding unallocated silver. Now, I know what some of you are thinking, but my bank is solid. My dealer is reputable. They wouldn't do that to me. And you're probably right under normal circumstances. But we're not talking about normal circumstances. We're talking about a systemic shortage of physical metal. We're talking about a situation where even reputable institutions can't source metal at reasonable prices. In that scenario, it doesn't matter how reputable they are. They can't deliver what doesn't exist. Let me give you a real-world example. In 2011, when silver hit $49 an ounce, there was a scramble for physical metal. Premiums went from $2 over spot to $8, $10, even $12 over spot for coins. Delivery times stretched to 3 months. And this was during a price spike when you'd expect people to be selling, not buying. Now imagine that scenario, but with industrial demand 50% higher than it was in 2011. With mine supply lower, with more paper claims outstanding, with less metal in dealer inventories. How high do premiums go? How long do delivery times stretch? And if you're holding unallocated silver, you're not getting those premiums. You're getting spot price maybe if they settle in cash. Or you're waiting months for delivery, watching the price move without you. Here's another angle most people don't think about. Unallocated silver is often held in jurisdictions with different legal frameworks. If you're in the U.S. and your unallocated silver is held by a bank in London, what happens if there's a regulatory change? What happens if there's capital controls? What happens if there's a dispute? You're subject to their laws, their regulations, their decisions. You have no control. You're trusting not just the institution, but the entire legal and regulatory framework of a foreign jurisdiction. Physical silver in your possession? That's subject to your local laws. You control it. You decide when to sell, when to hold, when to move it. That's the whole point of owning precious metals, to have something outside the system that you control. Now, let me address the convenience argument, because I hear this a lot. Unallocated is more convenient. I don't have to worry about storage or security. I can sell instantly. And yes, that's all true. But you're paying for that convenience with counterparty risk. You're paying for it with the risk that when you need your silver most, it won't be there. Is that convenience worth it? That's a question only you can answer. But I'll tell you this. The people who are most concerned about financial system stability, about currency debasement, about economic uncertainty, those are the people who are moving to physical possession. They're willing to deal with the inconvenience because they understand the risk. And the risk is real. We're not talking about theoretical scenarios. We're talking about things that have happened before and are showing signs of happening again. Let me tell you about the silver squeeze of January 2021. A group of retail investors on Reddit decided to try to squeeze the silver market by buying physical silver and SLV shares. The price spiked from $25 to $30 in a matter of days. Dealers sold out of inventory. Premiums exploded. The U.S. Mint couldn't keep up with demand. Now that squeeze fizzled out because the price spike brought out sellers and the momentum faded. But it proved something important. The physical silver market is tight. It doesn't take much buying pressure to create shortages. And that was with silver at $25. What happens when industrial demand is higher? When mine supply is lower? When more investors are aware of the dynamics? The next squeeze might not fizzle out. It might be the beginning of a permanent two-tier market. Here's what I think is going to happen, and I want to be clear, this is speculation based on current trends. I think we're going to see increasing divergence between paper silver prices and physical silver prices. I think premiums are going to stay elevated and possibly increase. I think delivery times are going to get longer. And I think at some point, there's going to be an event, maybe a COMEX delivery default, maybe a major dealer going under, maybe a regulatory change, that causes a rush to physical metal. When that happens, if you're holding unallocated silver, you're going to have a choice. Take cash settlement at the paper price, or wait months for physical delivery at prices that might be significantly higher than what you paid. Neither option is good. But if you're holding physical silver in your possession, you're sitting pretty. You have the metal. You can sell it at the physical market price, which will be higher than the paper price. Or you can hold it, knowing that you have real, tangible wealth that no one can take away from you with a keystroke. Now, I want to talk about something that's relevant if you're thinking about this in terms of retirement planning. A lot of people hold silver in IRAs, and most of those are unallocated or held through ETFs. If you're sitting on $100,000 or more in retirement accounts and you're concerned about these dynamics, there's a way to hold physical precious metals in an IRA structure. I put together a free guide on how gold and silver IRAs work. It's in the description below. It covers how to get physical metal into your retirement account without tax penalties, how storage works, what the rules are. Worth checking out if that's relevant to your situation. But back to the main point. The window for converting unallocated silver to physical possession is open right now, but it's closing. Dealers still have inventory. Premiums are elevated but not crazy. Delivery times are a few weeks, not a few months. You can still get out, but every week that passes, that window gets a little smaller. Every week, more people figure out what's happening. Every week, industrial demand consumes more supply. Every week, the ratio of paper claims to physical metal gets a little more stretched. I'm not saying there's going to be a crisis tomorrow. I'm saying the conditions for a crisis are building, and if you're holding unallocated silver, you're exposed to that crisis in a way that people holding physical silver are not. Let me give you the practical steps. First, contact whoever holds your unallocated silver and ask about conversion to physical delivery. Ask about timelines, costs, and any restrictions. Some institutions make it easy, some make it hard, some don't allow it at all. You need to know where you stand. Second, if conversion is possible, do it now. Don't wait for a better price or a more convenient time. The whole point of holding silver is insurance against uncertainty. You don't wait to buy insurance until after the accident. Third, If conversion isn't possible or practical, consider selling your unallocated position and buying physical silver from a reputable dealer. Yes, you'll pay premiums. Yes, you'll have to arrange storage, but you'll have actual metal, not a promise. Fourth, think about storage. If you're holding small amounts, a home safe might be sufficient. If you're holding larger amounts, consider allocated storage at a private vault. Allocated means the specific bars or coins are identified as yours, segregated from other customers' metal. It's not the same as unallocated. You own specific pieces of metal, not a claim on a pool. And fifth, document everything. Keep receipts, keep certificates, keep proof of purchase. If there is a crisis, if there is a dispute, you want documentation that proves what you own. Now, I know some of you are thinking this sounds alarmist, and maybe it is. Maybe the system will hold together. Maybe supply will increase. Maybe demand will moderate. Maybe the paper market will continue to function smoothly. But here's the thing. If I'm wrong, and you convert to physical silver, what have you lost? You've paid some premiums. You've dealt with some inconvenience. But you still own silver. You're still protected against inflation, against currency debasement, against financial system risk. But if I'm right, and you stay in unallocated silver, what have you lost? Potentially everything. You could end up with a cash settlement at a paper price while physical silver is trading at a massive premium. You could end up waiting months or years for delivery. You could end up as an unsecured creditor in a bankruptcy. The asymmetry of that risk is what should drive your decision. The downside of being wrong about the need for physical possession is minimal. The downside of being wrong about the safety of unallocated silver is catastrophic. And look, I get it. Physical silver is less convenient. It's bulkier than gold. It's harder to store. It's harder to sell quickly. But those inconveniences are features, not bugs. They're what makes silver real money, not just a financial asset. They're what makes it a true store of value outside the financial system. The people who understand this, who really understand what's happening in the silver market right now, they're not holding unallocated silver. They're not holding ETFs. They're holding physical metal in their possession or in allocated storage where they control it. They're doing this because they've looked at the math. They've looked at the supply and demand dynamics. They've looked at the ratio of paper claims to physical metal. And they've concluded that the risk of staying in the paper market is too high. I'm not telling you what to do. I'm telling you what the situation is and what the risks are. You have to make your own decision based on your own circumstances and your own risk tolerance. But I will say this. If you're holding unallocated silver as insurance against financial system risk, you're not actually insured. You're exposed to the very risks you're trying to protect against. And that's a problem. The solution is simple, but it requires action. Convert to physical possession. Take delivery. Hold the metal yourself or in allocated storage where you control it. Do it now, while you still can, while dealers still have inventory, while the system is still functioning normally. Because once the crisis hits, once everyone figures out what's happening, it'll be too late. The window will be closed. And you'll be stuck holding a promise that can't be kept, watching the price of physical silver soar while your unallocated position is settled in cash at the paper price. Don't let that happen. Get your silver out. Get it into your possession. Do it now.